You'd have to be living under a rock to not know that we're in the middle of a rental crisis in Australia. Over the past couple of years, we've experienced record levels of rent increases, record low vacancy rates, and record numbers of new immigrants. All things you would expect to encourage property investors to participate in the market. And yet, investors are selling up. What is going on?
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
Today, we want to understand why increasing numbers of investment properties are being sold, and we'll be talking with Nicola McDougall, the chair of the Property Investment Professionals of Australia, otherwise known as PIPA. Nicola is a property and finance journalist and the co-author of The Female Investor, Creating Wealth, Security and Freedom Through Property, which won the Personal Finance and Investment category at the 2022 Australian Business Book of the Year Awards. Well done. She's also the co-author of the 3rd edition of Property Investing for Dummies and the 1st editions of Buying a Property for Dummies and Property Investing Essentials for Dummies, all released in 2023 and published by Wiley. Nicola was the former editor of the Australian Property Investor magazine, former head of corporate affairs at REIQ, and has been voluntary PIPA board director since 2014, taking on the role of chair at 2022. And today we're going to discuss the results of the 9th annual PIPA Investor Sentiment Survey. Wow, what a mouthful. Thank you so much for joining us today, Nicola.
Thank you. It is getting a little unwieldy, that intro. But anyway.
It's what happens when you do a lot of things. You're a very busy woman.
I like to keep busy. Keeps me out of trouble, or maybe it creates more trouble for me. I'm not too sure, but I like it.
Well, the investor space at the moment is lots of trouble for everyone. So let's get stuck into that. Before we dig into what the survey reveals, can you explain the methodology so that we can get an understanding of who was surveyed?
Yeah, so the survey, as you mentioned, Veronica, it's in our 9th year, and we always run it in August every year, have it open for about 3 weeks. And we're obviously a non-profit association, so we generally send the survey out to our members, who then pass it on to their clients, who predominantly are property investors. And over recent years as well, we've been able to tap into the membership of our sister association, the Property Investors Council of Australia. So fundamentally, what that means is we are getting, everyday mum and dad investors. Perhaps the survey might skew a little bit more educated because of the databases that we're targeting. But this year we actually had a record number of respondents to the survey, some 1,724 survey respondents, which obviously makes the survey results very statistically reliable.
And what were some of it's really, the rental crisis is pretty scary, right? And, there's been a lot of targeting at investors over, many years now. They're the bad guys. And, now we're seeing the issue with not enough investors in the market, but investors selling is the real trend. What are some of the alarming results, I guess, you found through that survey? And, it doesn't take a rocket scientist to figure out that leads to some issues.
Yeah, exactly. And I think, the survey, we have a static number of questions in the survey every year, and I've been involved in every single one of them. So, I probably can't speak to anyone else who knows more about the survey than me. But over the years, obviously, the survey does evolve, and we do, talk about things that are newsworthy. 2019, we talked about negative gearing in the lead up to the election, things like that. And it really wasn't until last year's survey that we really decided to, do a deeper dive into the selling intentions, not only intentions, but the selling activity of investors, because we hadn't actually really been tracking that much, which is a little embarrassing to admit. But clearly we wanted to understand as, the peak association, what the heck was going on out there. So last year, alarmingly, it showed that, nearly 17% of investors, so this is in the 2022 survey, nearly 17% of investors had sold a property in the previous 2 years. So clearly this year when we were doing the survey, we asked the same questions, albeit we just asked them, what they'd been doing in regards to their selling activity in the previous 12 months up to August. And you could probably say quite truthfully, that the results are actually worse than last year, when more than 12% of investors actually said that they'd sold at least one property in the previous 12 months, whereas, as I mentioned, last year's survey was in the previous 2 years. That was probably slightly surprising to me. Last year's survey, the predominant reason why people had sold was to make the most of rising market conditions, certainly in markets such as Queensland, which had had fairly benign conditions for a long, long time. So we actually, saw an uptick in the selling activity of investors in the last 12 months, and a bit of a change in the locations where they've been selling as well.
That's really interesting because we'll get into the top reasons for selling, obviously, but I know there's been quite a remarkable change from that being opportunistic to perhaps being more fearful, perhaps. But also, there's interest rates in there as well, rising interest rates. So it'd be good to tease out that and to see if we can distinguish between how much of it may have been that versus how much of it was other factors, which we'll get into. But I thought also what was interesting was that only 24% of those 12% of investors that sold to another investor. And so if my maths is right, that's a 9% fall in the rental pool.
That's right, exactly, because last year it was 33% who indicated they'd sold to another investor. So, and you can actually see that through the lending indicators data from the ABS, that the normal volume of investor transactions or loan commitments hasn't been keeping up to trend and has been falling quite significantly actually since the start of the rising of the interest rate cycle in May last year. I actually just did some data yesterday, and the number of new loan commitments for investors have actually fallen 27% since interest rates started to rise in May last year. So you can see there part of the reason why those investors who were selling weren't selling them to other investors as much as they previously had been, because we've seen investors not transacting as much as they usually are.
And Nicola, have you got any idea of what the amount of, investor or rental, what is the rental pool? Is it, is it roughly 3 to 3.5 million sort of properties? Is what sort of numbers?
Nationally, I think off the top of my head, that's the one stat I don't have in front of me, Chris. So thanks for asking that question. I think it's around about 2.5 million. It's in the 2.5 million bracket nationally.
Okay,
nationally. But that's based on census data. Sorry, darling. That's based on census data. So that we're always working with this old data, right? But that is the best snapshot that we do have every 5 years of how many rental properties we have in the country. So that was based on the 2021 census data.
2021 or 20... So my calculation of 9% was basically that if 12% of investors sold and a quarter of those were sold to other investors, that means 3/4 left the building. And so that 3/4 basically makes up about 9% of the total pool. So we're talking a drop of over or close to 250,000 properties have potentially exited the market, which is significant given that what do we need? Is it 1 million we need or something? Anyway.
That's what the million that they're trying to build in the next 5 years. That's, that'll probably just mop up the supply that we need right now. And, with the data, especially last year when we decided to ask investors these questions, we actually did engage some independent analysis, of the data, because we couldn't quite believe, I guess, the figures that we were seeing in front of us. And also we actually even delved into the census data even more to make sure that we were actually just looking at pure rental properties. So not social housing, not any type of, government housing or anything like that. It was actually, true private investment properties out there to make sure that we were looking at that. And last year, potentially same thing, hundreds of thousands potentially of properties that had been stripped from the market. So look, between in the last 3 years, what could we say? At least you would have to admit that there'd probably be at least perhaps 10% of the rental market missing, at least, probably more than that, but I don't want to overplay it, missing in the last 3 years, because those properties have simply been stripped from the market, because not only have investors probably sold more than they historically do, but they're not selling. We don't have the same volume of investors coming into the market. So it's like a perfect storm. But also that perfect storm, and you probably heard me talk about this before, actually started in 2015. So we're at the tail end of 2023 now, but it started with the APRA changes, restrictions on lending to investors. And from that moment on, if you look at the data, if you're a data nerd like me, you can actually see the falling volume of new loan and commitments to investors start happening in 2015. They're usually around about 35% of the market, kept on falling, actually hit 22% in 2020, and has only relatively recently gone back to those historical averages. So we could probably safely say that this perfect storm that's created this critical undersupply of rental properties that we have now started nearly 9 years ago.
And yet it actually hasn't improved affordability for people trying to buy.
No. The argument often is like when we look at our data and there's a particular percentage of people who are first time buyers. People go, well, doesn't that mean that they've freed up the rental market? Well, it's not that simplistic. We don't know where that first time buyer came from. Highly unlikely that they were living by themselves in a rental property while saving to buy a home. They're probably in a share house, probably more likely to still be at home. So it's not as simple as saying that. But certainly, the usual supply, the usual volume of investors, which until 2015 created quite a stable rental environment across the nation, well, that's been blown apart since 2015 from a variety of policy positions and laws that have come in or even been threatened to come in, and investors have clearly been voting with their feet. Now that we're in an environment of much higher interest rates, clearly you've got a percentage of investors who simply can't secure the finance either.
Yeah. So what are some of the top reasons for selling?
This year, the survey, the results were very different than last year, and we always ask similar, we always give them, it's probably more than a dozen reasons, and they can choose a variety of reasons why they might have decided to sell, in the previous 12 months. And as I mentioned at the outset, the number one reason last year was those rising market conditions. But this year it was the number one reason, with 47% of respondents, was due to governments increasing or threatening to increase taxes, levies and dues. So that which made, property a much less attractive asset. So that was the number one reason why investors said that they'd sold their property. I was surprised by that. I thought clearly that, does do a lot of damage to investor confidence. I would have presumed that rising interest rates, given that this survey was conducted in August this year, so we'd had all of the interest rate increases thus far, I would have thought that was number one, but it was actually number three. Number two was changing tenancy legislation, making investors feel that they, not only losing control of their assets, but also increasing compliance and holding costs.
Nicola, there are two things that, tenants' rights, I'm probably for all those. I think there's, you shouldn't have to live in a substandard rental property because the investor's got the power, right? So we need to, I think there should be some high, barriers to entry there for investors and a responsibility for them. But the fear around the government changing tax settings and things like that, that's where you start really playing with the pool, right? Because if there's not enough new people, investing, then people leaving, and the problem with having, 2.5, 3 million investment properties, particularly owned by the older generation as well, right? Like they're getting close to retirement. They're not just, they're going, well, do I leave it in property? Do I put it into shares? Do I put it into my super? Like, it's getting quite lumpy in retirement. Maybe I should just sell down. Like, you don't really want to upset them too much, right? Because if they start exiting and you don't have enough people entering, then the pool shrinks as our population grows, and particularly as more and more people can't afford to buy or forced to rent. So, do you think that's the real issue? Is the government, basically, have created this fear for the investor, and the investors are just saying, this is all too hard. I'd rather, particularly in the older generation, I'd rather go for things that I can easily sell, like shares, and put more money into super than buy another investment property or sell one.
100%. And, a prime example of that, Chris, was the survey last year when at the time, that ridiculous Queensland interstate land tax had been brought into law, and as luck would have it, as timing would have it, our survey was in August. So we, and look, at that point it was already law. It hadn't been in for about 2 months or something like that. But in regards to investors saying, indicating what their selling intentions were for the year ahead, which is what we ask as well, the number one reason why they said they would sell in the year ahead was because of that tax. Right? And that was something that actually had already come in. As we know, PIPA's been very proud to be part of the campaign that actually ultimately saw that tax repealed 6 days later after our research came out. But it's never ending. It's quite exhausting for those of us, who have been involved in property, and we all have in this discussion for decades. But it's quite exhausting where it's just never ending. There's various state government levers that are pulled. We're always continually seen as the cash cows, like, oh, we need a bit more money. Well, let's just do that with investors. Obviously, in Victoria, we've seen, a raft of not only tenancy reforms, but also the new land tax schedule there, and a variety of other things. And people, I just feel that, like, when we actually just sit back and go, okay, well, we know, again, from the census data, that about 71% of investors only own the solitary property. There's a variety of reasons for that, which will be another, I'm sure you've spoken about on the show. But often that means that, the majority of investors perhaps are accidental, or they have gone off and bought one and they don't have the risk profile to expand on that. They might have bought a bit of a dud. They aren't actually able to buy any more, anything else. They just don't want to, whatever the reason. They've bought one property. That's all that they will ever do. And that probably doesn't take very much to spook them. And so in an environment when we've seen interest rates, skyrocket, and also at the time, all these policy changes happening state by state, even at council level too, like, it's never ending. I guess the only thing that hasn't happened is the feds haven't weighed in this time, which is quite nice from a policy, in an industry representation point of view. I'd have to clone myself even more than I do. But, there is just so much going on. It's overwhelming is probably the right term for it, not only at an industry level sometimes, but also for everyday investors who predominantly only own the one property. And they, many of them perhaps may not be able to financially hold on to those properties now in an environment of higher rates. I did see some research recently that said, it is those short-term holds, properties that are being offloaded in greater numbers at the moment, and often for those investors at a loss. So clearly, financially, they just aren't capable of holding on to those properties.
You've also got a number of investors that have held on to properties under adverse conditions for a long time. So in Perth and Darwin, for instance, have had a long history of losses or no gain. Brisbane had a very long period of time with very little activity in terms of capital growth. And certainly if people bought brand new units in Brisbane or Melbourne and more recently in Sydney, they've struggled with capital gains as well over the years. And so, like you said, the survey last year in 2022, which looked back to 2020 and said, who's sold over that period of time and why, you can understand why people would have taken the money and ran if they'd actually been suffering that and they suddenly saw some gains. But also rents, there'd been quite a lot of downward pressure on rents really in the lead up to COVID. And then, of course, since then, now, in some cases, rents have gone beyond where they were beforehand. But I know my own personal rental situation, a couple of properties that I've got, that only recently have actually regained the rents that I was getting, say, back in 2017, 2018. So a lower yield. I've had capital growth in mind, as you would hope, given what I do for a living. But if you had low yield as well as low growth, you can absolutely understand why people said, I'm going to get the hell out. You can also understand why those people, if they were in Queensland, would be saying, oh, no way, I can't cope. I cannot cop a tax on top of the fact I've had no growth and very low yield or lowish yield in Queensland for many years. So that sort of makes perfect sense. But I think the real change around the motivation and the reason for selling is really telling. But also, I think the states and territories that are perhaps harder hit than others. Could you sort of dig into, because this is, I think, you can talk about why and people tell you why, but then the evidence plays out, doesn't it? It's the states that are most aggressively targeting investors with their legislation or proposed legislation. Investors have voted with their feet, correct?
Well, and you would think that, the states that have the highest populations, therefore, naturally would have, the highest volume of sales because there's just, more people, more properties, probably more investors. But that's certainly not the case because this year the survey showed, and look, last year we actually only asked them at a state base where they'd sold. And as I say, this survey does evolve so we can actually, create and get this more data and so we can all understand more what's going on out there because it seems like a basket case a lot of the time. But this year, about 25% of investors said that they've sold a property in Melbourne, which was the number one place, and that was a big surprise to me. The number two was Brisbane, and then it was number three was regional Queensland. But when and I think it was 6.4% sold in regional Victoria. So there you go. 30% of survey respondents said that they'd sold at least one property in Victoria in the previous 12 months. And as we know, in the previous 12 months, Victoria has been the one that's sort of been hitting investors over the head with a sledgehammer the most in regards to these new policies, which generally make them, increase their holding costs and make them really, I guess, question whether being an investor is really worth it. And many of them have clearly answered that question for themselves, rightly or wrongly, have decided that the numbers don't add up for them, or they don't want the stress, or they're just sick and tired of always having to, fork out hand over fist, and they have exited the market. What's interesting, though, just going back to what you said before, Veronica, last year, 40% of investors, of survey respondents, 40% had said they'd sold at least one property in Queensland in those previous 2 years. I was one of them. Every person that I know who owned in Queensland in that previous 2 years, and I know a lot of investors, we sold at least one, because exactly up until COVID, capital growth was terrible, and generally speaking, and rents had been going backwards for a number of years. So when I actually managed to get a little bit of, I got a little bit of capital growth for a property that I owned for 15 years, I totally decided to sell one of them. I did reinvest it into a better property, but still, it was time to get rid of that one. So, it certainly appears from the survey results that investors, they're sick and tired of being treated poorly by policymakers. And I've often said many times, that I just don't understand, why the vital role that investors play in society is not more valued across the board. But certainly what I've seen over the last, probably since our latest surveys come out, or maybe just before that, PIPA's been very active in preparing policy submissions at state and federal level, and that's created a lot of opportunities for us to sit down with both state and federal representatives to represent investors. And I've been on the board for 9 years. I've been involved, in industry representation since 2006. But certainly from a property investment point of view, I don't recall ever a time where we had the opportunity that we do at the moment, because policymakers are finally, I would hope, I'm not saying it's there yet, but it certainly appears that they are open to discussions with us. And I've always said it's a symbiotic relationship between tenants and investors. One can't exist without the other, but there has been, until now, pretty much only policies generally have been going only one way, a bit lopsided, and just to even have a voice is what we're looking for.
And I mean, that is something that I've often wondered about. Why is it that it's seen that tenancy reform and supporting investors are seen as mutually exclusive by so many? Is it because it's politically expedient to sort of do a bit of investor bashing?
I abhor that greedy landlord narrative that is pervasive in this country, and certainly in the media, is untrue and frustrating. And I do my utmost every day to try to change that. I think one of the problems perhaps that we've had at an industry level, and certainly for property investment, PIPA has been around since 2005, but we are a non-profit membership organisation that's 100% self-funded. We, survive and thrive on our membership dues, on our training program and things like that, versus tenants' unions, which have government funding. And when they are getting, millions, I think some of them get in funding per year to run these tenancy organisations, and they do have obviously services that they supply to tenants. It's very hard when you've got, until relatively recently, these quite grassroots property investment associations. It's very hard to compete with someone that's, obviously their coffers are full, and we are doing the very best that we can with what we've got, but we're not in the same league. So perhaps it's that. I think as well there has been an environment where we've just been taken for granted. I think we're taken for granted, probably for the best part of 2 decades, that investors would simply be there because of the capital gains, or, because, we get a little bit of negative gearing sometimes, What really annoys me is no one ever talks about how much capital gains tax we pay. It's very hard to get that data, I tell you that too. Tried it through FOI, through the ATO. So it's very hard to get that. But I think we've just been taken for granted for a long time, and the equilibrium is gone now. It's been gone for a while, but it's only the last 2 years that it's become apparent. And I think policymakers, politicians of all, political persuasions have no choice now to actually get us to the table, because the system is broken and we are a huge part of the solution.
Nicola, I mean, I'd love to say that I can see something through speaking to our clients that something's going to be different. But if you just start role playing out over the next few years, right, and even if rates stay reasonably high, right, even if they drop 1%, people are still going to be hurting on their mortgages a lot, and so they're probably negative cash flows on their investments are still going to be there. And so I feel like a lot of investors will make the choice of selling their investment property because their home loan's now more expensive, right? And when you look at how much people can borrow, it's very limited right now, So, and if borrowing capacity goes up, most likely that'll be factored into prices really fast, and so people have to spend it because there'll be momentum in the market. So there won't be lots of excess cash for investors, I don't believe. And I think a lot of investors are getting pushed out of the capital cities anyway because their borrowing capacities are really tight. And they're going to areas potentially where there isn't a rental crisis, right? Where, they're going to areas that are a bit more on the affordability and in the regional areas, right? Which, and so what do you think, what is PIPA campaigning for, I guess, with the governments? Like, because you need a lot of things. I think, a lower investor interest rate, because it's actually got lower risks than homeowners. They're actually default rates. You could arguing for, higher LVRs. Like the banks have started to do 95% LVR. So, because lending's a big part of it, but APRA might have to step in to reduce the serviceability buffer. What other things I think are PIPA campaigning on, that'll give investors more confidence to enter the market when, at the moment, the tide's going the other way?
Yeah, I think, whilst all the data is showing that investors are exiting the market, from a strategy point of view, I don't think they should be if they can, they shouldn't be spooked. I mean, those of us who've been in the game a long time have had moments like this before, peaks and troughs of policy or of market conditions, and it's about, writing that out, the whole keep your eye on the horizon because it's actually true. Because it is a bumpy road a lot of the time, and there's a lot of the time when nothing happens. A lot of the time when good things happen and some bad things happen, but it's actually what's happening in 30 years' time that's of all the difference. But it's a good question, Chris, because we're actually at the moment doing some research about all of those things. Certainly about the interest rates. There are some issues in some states with stamp duty. Obviously stamp duty, well, that's just a whole other show. But, for Queensland, for example, investors pay a significant, like thousands and thousands of dollars more in stamp duty for the privilege of owning an investment property. So we are looking at a variety of things at the moment. Certainly, I have had the opportunity to sit down with a number of policymakers over recent months, including with the Queensland government, which, kind of blew our socks off a little bit, and had the opportunity to address the Queensland Housing Roundtable as well. And I have got an invitation to go and meet with the Queensland Housing Minister as well, which has been a long time coming. Not very often, PIPA's been invited to sit down with Labor politicians in the past. But that goes to show the opportunity, unfortunately it goes to show how broken the system is, but it also goes to show the opportunities that we have in front of us. And generally speaking, I just advocate on behalf of investors and really try to get the policymakers and, decision makers to consider incentivising investors. What that looks like, we're not too sure yet. We have been asked to put some thoughts together for the federal shadow housing minister. But insist and incentivise investors not only to come back into the market but hold for the long term. So stopping a little bit of this churn so that we can help to create a more stable supply of rental accommodation in the country, because we don't have that at the moment. And you're right though, Chris, I think we might have even done press releases about this in 2015 when those APRA changes came in. So, 9 years, let's call it 9 years in the making. How long do you reckon it's going to take us to to dig our way out of this. And investors, PIPA put out a press release this morning because of our national market update, which we do, every few months. But in it, some of the commentary from me was about the fact that governments seem to be quite ready and willing to incentivise the big end of town. For example, on the supply side, build to rent, which I don't think that's a bad strategy. But they haven't offered 1 red cent to investors as an incentive when we supply more than 4 out of every 5 rental properties in this country. So come on, guys, come to the table. Like, we are the solution. We're not just part of the solution. We are the solution. And it's about time that they seriously, recognise that.
I'm on a personal mission to help more people make better property decisions. And you can find out all about what I'm working on at veronicamorgan.com.au. And there you'll find resources for first home buyers, details about my buyer's agent mentoring program, access to suburb help for investors, or if you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or lower North Shore, you can connect with my team at Good Deeds Property Buyers.
If you're thinking about buying your first home, upgrading to a new one, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and importantly get the finance right. Please reach out via our website, wealthful.com.au.
Don't forget that you can download our free full or forecaster report. Which experts can you trust to get it right? theelephantintheroom.com.au.
I think we have been the solution for decades. And I think that in the meantime, it's, people are crying, when did housing become a commodity? Why should people be now getting wealthy off property? And it's like off the roofs, the roofs over people's heads. And I get the social sort of aspect to that, but it's like our governments have allowed that to happen. In fact, encouraged it to happen because they stopped their own investment in public housing. And so somehow, the stock has got to be created somewhere. The problem, though, with, I guess, it's not just a rental crisis and a shortage of rental accommodation. Generally speaking, we've got a housing shortage. So, moving the deck chairs on the Titanic is one thing. To say that, okay, well, taking them away from first home buyers or from owner-occupiers to put back into the rental pool, there is a bigger problem here, of course, which is supply. But I think that this is a very important conversation to have because, as you say, 4 out of 5 properties have been provided by mums and dads investors or individual investors, and 71% of investors only have 1 property. So we don't have a powerful lobby group. We've got a small PIPA, and PIPA actually doesn't really represent investors. It represents investment, professionals.
Right.
So, it's like a proxy.
We're doing it by proxy, really, just because we've got the platform. So we do a catch-all, really, because when you've got the opportunity, you might as well use it, right?
Yeah, it was at kill 2 birds with 1 stone.
Yeah, totally.
How do investors rank the states for their support of property investors?
Well, and not interestingly at all or surprisingly, but Victoria was rated as the least accommodating state in the nation for investors in the past 12 months. And that's because of the, as we mentioned, the plethora of rental reforms and mainly that new, the new land tax system that pretty much slugs almost everybody, I believe, so that they can pay back all the money that they spent during COVID. But just as a prime example, isn't it? A prime example, we need to get some more money in. We spent all this money during our, 50 years of lockdowns.
Here's the cash cow.
Investors, they're just a complete misunderstanding of the average investor. And it's very hard. Like, I know you guys do it, I do it. You bang the drum, bang your head on, against the wall so many times and try to get them to believe that those numbers, which come from the Australian census, and they generally haven't changed over the years, that 71% of investors own 1. I was actually at something recently and I had someone from the opposing side of our industry question my data and said that the data that they had was the complete opposite. And I didn't actually get the opportunity to rebut that and say, well, ours is from the Australian census. I'm not too sure where yours is. I would presume it was made up. But anyway, so yeah, it is very frustrating. But you did say something before, Veronica, which I actually meant to say as well. It's like the government's been caught on the hop here. When I say the government, I mean, state governments or any governments of any persuasion over the last 20 odd years who have a fundamental responsibility to supply social housing for their residents. And Eliza Owen had some great data that I heard her mention in a quite a good show on the ABC. But I think around about 10% of new housing supply used to be government funded until about 20 years ago. That was sort of standard. So your social housing, obviously, things of that nature, and that is now under 2%. So you want to know where those properties have gone? So that's what used to happen. Governments used to fund around about 10% of new supply. And then because when let's be honest, from about the mid-90s onwards, that was when investor activity really started to ramp up with private investors. And I think at that time, obviously, we had the CGT discount, negative gearing and things of that, but also, some fairly decent market conditions over blocks of time over the years. And I think that governments kind of went, oh, whoopee, we don't have to do that anymore. And so they did it. And not only did they not create that new supply, they also sold the supply that they had. Look at the Rocks, for example, or anywhere, Brisbane, well, you name it, the supply that they had, they actually sold those off at the same time as not replacing them with, supplying 1/5 of what they used to. And then, so that was happening quietly in the background without anyone really taking any notice. And then obviously from 2015, the investors who had been quietly there for a couple of decades were no longer there in the numbers that they used to be. And not only were they not transacting, getting into the market, they were actually selling in greater numbers than they would normally do as well.
I think it's interesting, though, that Victoria, the response there to the government sort of saying, okay, well, property investors are a cash cow. We need to refill the coffers after the COVID lockdowns. And then you've also got the situation where property investors also took a hit across those lockdowns. There's various rental moratoriums, and if you were unlucky enough to have a tenant that was affected, that their job was affected, you couldn't do much about it. If you're unlucky enough to have a high mortgage at that time, or only just purchased the property and you hadn't actually accumulated much in the way of equity and you had a huge amount of borrowing, so each individual investor was in a different situation. Some have very low debt. That was very easy for them to help. And others were in much more dire circumstances themselves, might have even lost their own job.
I think that's a very important point to make, Veronica, because I think all of us, are forever changed from the COVID experience and across a variety of ways. But certainly if we think about, my own example, I remember when those lockdowns happened, I was newly married, but I'm a small business owner. I owned 3 investment properties myself. And when those moratoriums came in and, probably my mortgages were 1.5 million or something, and I had 3 tenancies by myself, I owned them separate to my husband. I actually thought to myself, I'm stuffed here. And I thought, I thought my business that was the end of my business, as a lot of us did, right?
That's the problem when you're...
my business is about to go down the loo and I am completely screwed here. And I think there are a huge cohort, and certainly in my circle of professional, not so much professional friends, but very educated investors as well, where we have, and we're only, all of us are only, recently, 50, still got a fair amount of time in the market, but every single one of us is sold, some far more than others, because we just never want to be in that position again, because it's terrifying for so many reasons, but financially as well, that, the rug could be pulled from under your feet just like that, honestly, just like that. And I think, which was part of one of the reasons why we asked that question last year in the survey, was I think that a huge volume of people have been selling because of moments like that, pure terror for a bunch of reasons, but they just never want to be in that situation again. And unfortunately, as we saw during COVID, we were mostly powerless with some of the decisions that were made on behalf of, citizens, whatever they were, whichever policies they were. So I think a lot of people just decided, I'm just not going to put myself at risk like that again, regardless of whether that's ever going to happen or not. But obviously they can make their own decisions based on how they feel about something.
Well, it's easy to take risk borrowing money when prices are rising and when interest rates are low and when there's none of those, black swan events happening, and then all of a sudden when something like that does happen, it does suddenly put in the picture, you think how fragile how vulnerable am I to this? Back to the increased interest rates, because if I was looking at the report, the results of the survey, and if increased interest rates were high on the list of motivations in the past year, you'd expect Sydney to have had a high number of sell-offs, but it hasn't played out. And I'm wondering if there's any sign of a delayed impetus to sell in the most expensive city.
Oh, that's a very good question. I mean, I think actually, if I had a question on notice about that one, I would have looked back through, because and this is something I want to do, because it's actually really interesting to see the data, how it changes year to year. But I think generally speaking, Sydney has often sort of been quite low in regards, we used to ask about selling intentions and things like that. So I would need to look into that more. I don't know. It can be, obviously investors feel happier there. Perhaps they've got more capital growth. Maybe they're not as highly leveraged, all of these things, because, you know, there's a huge volume of people in Australia that cannot afford to buy in Sydney, let alone invest in it. So perhaps it's that. It could be that.
Just a higher net worth in the first place.
Well, perhaps maybe next year we'll see, you know, that change. That's the great thing about this data set that we've created and that we are creating, is to actually, because no one really had been tracking investor sales, which is really embarrassing until, you know, we kind of started to do it now. There's a bunch of data houses that are doing it too, because I think no one really cared about investors selling before.
Well, CoreLogic do have their quarterly pain and gain report, which is my favourite report.
Oh, would be, wouldn't it?
Yeah. You know, I love a bit of contrarian stuff. I like to get into the nitty-gritty. And so obviously they do track investor selling, and also the proportion of loss-making sales versus owner-occupier, which is a whole topic. In fact, if we haven't released it yet, we've got an episode with Eliza coming up, which is...
Oh, great.
Actually, we would have released it before this comes out, so we've recorded it, but it hasn't been released yet. But I'm curious to know, do you think the rate... So you may not have the answer in your fingertips around Sydney, you know, the intention to sell in the future, but do we have any idea about the rate of investor selling? Do we think it might have peaked, or do you think that there's still an intention for people that haven't yet sold to sell?
Well, funny you asked that, because that is a question that we do ask. And what was probably, you know what, the most telling statistic in the survey, and probably the scariest one in regards to rental supply, was the question this year, which we asked last year, and we always ask, you know, what are your selling intentions for the year ahead? Now, last year, 19% of investors said that they were, likely to sell, and 12%, 12% ultimately did. This year, though, 38% of investors said that they were likely to sell within the next 12 months. So that's like double the amount of investors. So that is, and it's interesting. What is that about? I think, look, let me tell you, no, my best guess would be that in August last year, we did have the temporary market slowdown happening. You know, clearly the investor sentiment surveys is about sentiment, in regards to, buying. Often you see the results kind of saying, oh, well, we don't think it's a good time to buy when prices are flat, and you're kind of like going, well, actually it is. But with selling sentiment, when you've got those prices starting to increase, well, clearly this year investors are feeling more confident, and maybe it is the rising interest rate environment. And next year we will find out this information. But, well, that is horrific when you think about that. Last year, 19% said that they would sell, and
12 did.
Two-thirds of them actually did. So what numbers does that look like next year?
Nicola, I guess it's that would be my concern, which is kind of what I was mentioning with, higher interest rates, burning them on the home and their investment property. Well, actually, you know what? That'll get us through this window of higher interest rates, particularly if they stay higher for longer. And I reckon the other issue, I think, is that a lot of first home buyers who want to buy places to live in are actually buying investment properties. And they're not, before they were doing that as the rent-vestor mentality was, oh, I'll buy 3 investment properties and I'll rent where I want to live. My worry is they don't believe in that strategy. And I think even some reports out this week showed that, even the next generation have really high home ownership desires, right? They're not saying we don't want to own a home. Like, they actually are higher than previous generations. So my view is that, that even these people who are buying investment properties now, they're not long-term investors. They're really just doing something to, rather than leave that money in the bank, and because they can't afford to get a place, or maybe they're in a new relationship, or they're single, let's get an investment property. And then ultimately, when I can afford to buy a home, I'll sell that. So they're not creating long-term rental stock. And I reckon there's a real issue with people that basically just can't afford to buy an investment property. I just don't think there's that future demand because they've taken on such amount of home debt under very low borrowing capacity. So unless borrowing capacity goes up a lot, but higher borrowing capacity will lead to higher prices. So I don't think there's much money there. I just don't know where these new investors are going to come from long term. Because if particularly we've got this whole cohort of older people that are getting to the stage of life where property becomes lumpy, it becomes hard to manage. It's a low yielding investment. I could either put that into shares or commercial property. You might get this issue where you just can't create enough rental stock, and build to rent won't do anything. I mean, it might add 100,000 or 200,000 over the next 5-10 years. When you've got 2.5 million investment properties, it's really around the edges. Is this something that the government's, I guess, really aware of?
I think that's a really scary idea, but I tend to agree with you. Like maybe the glory days are behind us, in regards to the private investors doing the heavy lifting, because the capacity and the desire, and let's be honest, we're in a low interest rate environment for more than 10 years from the GFC.
It's still low in the whole scheme of things.
Yeah, well, that's right. But maybe that's the glory days are done. And I actually was at I got invited to the National Housing and Homelessness stakeholder meeting last week, which was online, which is, again, a great opportunity for PIPA to be invited to these types of meetings. And we did have the opportunity to put forward some ideas just generally about housing. Because, look, at the end of the day, obviously, PIPA, we represent people in the property investment advice sector and by proxy investors. But we believe in property as a way to improve, your financial future, housing security, all of those things. And so whatever can happen at policy level to help encourage young people to purchase their own home, not necessarily an investment property, that's good for everybody, right? So I sort of suggested, obviously the stamp duty clearly needs to go. I guess the stamp duty needs to go. But also there was, even if you're thinking about the first homeowners grant, that's only for new, really, isn't it? At the state-based level, has been for a long time.
It varies from state to state. It's not always for new, and thankfully not, because it's actually not the best thing for first home buyers to buy.
No, that's exactly right. But I mean, the actual grant itself, generally it's about 15 grand. So that means it's doubled in the last 20 years or 23 years. I mean, come on, that's not in line with market, all these types of things. So there are a number of policies that can be changed or new ones. Geez, it'd be nice to have it a first investor grant, wouldn't it? Look, why don't we put it out there? Now's the time. But if we need to do whatever we can to encourage not only young people to try to become a home buyer, but also encourage, younger or a little bit older people to become investors. Because I just don't know, like you said, Chris, that's a really interesting point. And I'll probably be pondering this for a few days after that meeting, after this conversation. Where if that, we've had this volume, this specific, particular volume for all these years, if those days are done, honestly, we're even in more dire straits than we are now.
Mm-hmm.
Where are people going to live? Are we going to be having migrant camps like we did in the 1950s? Look, got all these new overseas migrants coming. Lord knows where they're going to be living. But yeah, I think, and I guess in a way, from an industry representation point of view, this creates great opportunity for us because, and it's not, just obviously we always get a huge amount of pushback when I represent the industry, which is why I don't read the comment sections on media stories. Best not to. Often they don't even open them up. But anyway, but it's a great opportunity for us to have open discourse with policymakers to ensure that we can, be the solution and help to create some strategies and some policies that can secure rental, supply into the future.
Yeah, I think it really does come down to credit. So, I mean, I would say that could being a broker, but I can see, what people can and can't do based on current access to credit. And
Why do we pay higher rates on our mortgages as investors? What's that about?
well, I think it was just a way of just actually targeting investors, right?
It's a disincentive.
And, I think what we need to do is kind of flip access to credit a little bit and, give people more certainty, even things like interest only. So if you're an investor buying, you got a 5-year interest only, you used to be able to get 15 years. Like 5 years goes over pretty quick, right? And so if you're an investor and you bought in 2018, 2019, 2020, 2025 or 2024 is going to come around fast, right? And where borrowing capacity is falling 40%, they can't refinance and extend their interest only period. And so that property that's slightly negatively geared or even positively geared, and it can very quickly flip to massively negatively geared because now they've got to pay capital plus the interest. And I think this is a bit of a ticking time bomb, right? Because they won't be able to refinance. They'll go, well, I just cannot afford it anymore. I could afford the negative cash flow if it's interest only, but I can't afford. This is like the big interest only cliff that people spoke about in 2018, 2019. That could almost recreate itself in the next few years if access to credit stays really tight. And whereas, that cliff didn't happen because access to credit was still, big multiples of salaries and people were able to get their way through. I just don't know if they're going to be able to get their way through it in the next few years on top of everything else. So, I think it's something the banks, need to get on now and basically create, policies where it's a low assessment rates. And if you're an investor that's had a property for a number of years, you might not be able to service this, but will allow you to extend your interest only and things like that. So I watch this space. Nicola, you've seen hundreds and thousands of property stories. Have you got a property dumbo for us?
What's a property dumbo?
It's an example, preferably a personal story. We love those ones.
Okay.
Of a silly thing or a mistake that has been made that creates a lesson we can all learn from. And it's not to call you a dumbo. It's just because Dumbo is a baby elephant.
Oh, that's easy. I bought it off the plan unit in South Brisbane in 2012.
Oh, is that the one you sold last year?
No, it's not actually. No, I sold it a townhouse, but I did sell that to buy a development site up on the Sunshine Coast, so that worked out quite well for me. Look, that is
What happened?
it's still in my portfolio. I don't know. Its capital growth is happening now, but the rent on that place when it was first built, and look, I wasn't working. I was working at the REOQ at the time, so I knew a lot about real estate, not a lot about investing. And the sales.
It's a good distinction.
My thank you. And the salesperson was very cute. And I was single. So I bought it. I did buy, no, I'm not even going to try and justify it. Anyway, so when it finished, the rent on it was $465 a week, which is pretty good. 1 bedroom, obviously. 1 bedroom, 1 bath, 1 car. It is very close to the new Queen's Wharf development, though, so I think it's just starting to earn me some money after 10 years.
Is that part of the dumbo as well, that you bought a one-bedder?
And then the oversupply happened, and then the rent went from $465 down to $380, and then it was $380 for ages until COVID hit, and currently it is at $500, but it's about to go up to $600. But there you go. So when I bought it in when it was first listed for rent in 2013, it was $465, and until relatively recently, it was $500 a week, and that took 10 years to get back to above it. So that's my dumbo.
And what about the capital value?
Yeah.
Should I sell it? I don't even want to talk about that.
No, you have to, because that makes the dumbo complete.
It's probably $100,000 more than I paid for it 10 years ago.
And what about the worst? When was it the worst? Like you thought, I bought it in 2012, and
if I had used that purchase price and gone and bought a little post-war 10Ks from the city, which I probably would have been able to for that purchase price back then, I would have made $500,000.
Yeah.
So yes, that was my big, very expensive learning fee. At the moment, I always go through this thing of whether to sell it or not, especially at the moment. But now I kind of feel that it's finally increasing in value, and obviously the yield's good. It's almost positive. You kind of it doesn't actually cost me anything. So
that old chestnut.
But I think, do you feel your unpaid professional advice? I feel that I probably should, from you, Veronica, I'm hoping for, I think I know the answer is I should sell it, right? But for some reason I just don't, which is ridiculous, right? I'm the head of PIPA and I've been doing this stuff for a long time.
If anybody wants to learn the process to go through to decide whether you should sell a property or not, for an investment property, I actually, on my website, veronicamorgan.com.au, if you go in the resources section, I've got a little masterclass, how to decide whether you should sell a property or not. It's
okay.
Like, I sell it for $35. You know, for you, Nicola, I'll give you a copy for free, right?
Darling.
So it's a half-hour masterclass. It takes you through 6 essential questions you need to go through. To summarise it all, I look at properties as flyers, floaters or flops, right? If it's a flyer, it's like A grade, and try never to sell a flyer, right? If it's a floater, it's B grade. So it'll bob along with the rest of the market. It's never going to set you on fire, but it's not bad, right? And a flop should always be gotten rid of, right? So then you got to work out. We know it's not a flyer. Is it a floater or a flop? Now, if it's a flop, yeah, you got to try and get rid of it.
I don't think it's the flop. I think it might be a floater because I've got a flyer. I've got a couple of flyers.
Yeah. So if it's a floater, the decision then comes in. There's a lot of other factors you got to take into consideration, right? So you got to think about how old you are. You just said you were 50. So you're less likely to sell a floater when you're 50 than you would if you were 30 because, you know, it's the runway and the opportunity cost of less capital growth and that compounding benefit over a longer period of time. So there's more upside for somebody to get rid of a floater earlier than later. You look at things like your tax position. You look at things like, you know, the cash flow on it. You look at things like, has it been a floater or has it been a flop previously, but now all that development's finished, the surrounding development's finished, and now it's just going to sort of be a floater, whereas before it was a flop. So there's lots of those sort of contextual questions. And there's also, you know, in terms of your personal life, some people might have a business that they want to invest in, and it might be just that it's just a drain on cash flow. And so there are other reasons you might choose to sell it. So the decision to make a floater to sell a floater or not is always much more complicated than a flyer or a flop.
Okay. Well, thank you for that. I think that's made me feel slightly better about my hesitation on selling it. But I still have not offered a new lease to my tenant because I am still on the fence.
You're holding your cards close to your chest. You want to become a statistic in the next report.
But as Kristen said, you know, my ability to secure finance to do something else at the moment is not there. So
well, that's another very important fact is what are you going to do with the money?
Nothing, because I can't.
Yeah, in which case you might not. Yeah.
But there you go. There's my Dumbo story.
Yeah. Eben has made a nice point around, you know, the investor and the rental supply, right? Like, I'm not going to give a long lease because I just don't know for myself. And, you know, that's one of the inherent problems in all this conversation. So, Nicola, thanks so much for coming on. It was a great chat.
Really good chat.
Thank you for having me. I hope I didn't rabbit on too much, but I'm very passionate about this and look forward to talking about the survey more with you in the years to come because we are creating like a really, you know, robust and very interesting data set that's very useful for us all.
Definitely get you back next year.
Okay. Thanks.
Thank you.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.